So there's groups of investors. In this particular case, we received 2 offers on 2 different properties, but they're from the same investor, so they sort of follow the same format, and we have sent you those so you could take a look at them. And what they're doing is they're submitting what they call a letter of intent. So first of all, what's the difference in a letter of intent and a real offer?
Offer is if you sign it, we're in contract.
Right.
So whatever you write and somebody signs it and says, I accept, now you're bound together.
Right.
But a letter of intent says, I intend to do these things.
Yeah. If they'll work with you, then we'll move forward to create an agreement with these terms. So what they do is they say, we'll give you this amount of money, and in many cases it's the full price for the property or close to it. They'll make a very small down payment. They'll cover all their own closing costs, and then they'll ask the seller to do what's called seller financing, which is they'll take the purchase price less the amount of down payment they make and have the seller finance everything. And then they'll put it in the form of a balloon payment. So after 7 years or 8 years or 10 years, we'll pay the whole thing off. Number one, in your opinion, why do investors think they can make these kind of offers on properties and have a seller actually consider them in today's market? You may or may not have an answer to that.
I think I would approach it, the view is different. The investors are not offering you full price in their mind.
Right.
And the reason is this is sort of a continuation. I've seen a lot of these lately.
Yep.
And it's a continuation of they will make a purchase of your house for $500,000. It's probably worth $570 in their eyes.
Yep.
Right?
Yep.
And so they'll buy it and they'll say, I have the right to assign the contract.
Right.
And then they'll go try to sell it for $570.
Right.
And then they'll get an assignment fee. And so you and I go under contract, and I say, I'll buy your house for $500.
Okay.
But I have the right to assign it, or I have the right to go find a new buyer.
Okay.
And if I find a new buyer, you, the seller, will sign a contract with the new buyer and replace the existing contract between me and you. And the fee difference, a novation fee, will be the difference of the 2 prices, $570 and $500. And so now back into the example, I'll buy your house for $500.
Yep.
You have a $300,000 mortgage.
Yep.
I will make payments on that $300,000.
To the lender. I'll make the payments directly to the lender.
I'll make the payments to the lender directly.
Okay.
And I owe you $200.
Okay.
So we'll do seller financing for the $200. I'm gonna go ahead and sell it. And so the one you showed, which was 84 months, you've got to believe that an investor will pay on that contract for 84 months. What happens is it's a lot of trust with somebody you don't know that's not wanting to live in the house, and they're using your credit, and they're giving you $200, but unless they're giving you some $100,000 or $50,000 to take the risk, and unless the note that they're giving you is short term, a few months, they're very dangerous. And they're pretty dangerous even in that regard, because you'd have to foreclose. But if you got enough money up front, then you would have enough money to foreclose on them if they didn't pay your balloon note pretty quickly.
Yep.
As the seller, you have a mortgage on the property. You're still responsible for that mortgage, and if they don't pay it, it's your credit. And so another big issue that people don't notice is who's going to insure that property.
Right.
And so these
I didn't think about that.
investors or whoever, these people who are trying to buy it, I'm not saying they're all bad. I saw one the other day, like I said, that actually was legit. The thing that tripped me up on that one was who's going to insure the property? Because if you sell it and you transfer a deed, generally the person that bought it wants you to keep insurance on it so that the lender won't know that the insurance got changed to the new buyer.
Right.
If you sold it, you can't insure it. And so the buyer would have to get insurance. And if the buyer gets insurance, and the mortgage company gets a new insurance policy that says there's a new owner, they'll call the loan.
Yeah, says Joe O'Kelly now got the insurance policy, but the property's in Cleve Gaddis' name. That winds up being a problem. Right. I never actually had thought about that.